2% cash back. 3 points per dollar on dining. A sign-up bonus worth $800 just for spending a few $1,000s in the first 3 months. Credit card companies have gotten very good at making rewards sound like free money. But here's what they don't put in the commercial. The average American household carrying a balance pays over $1,000 a year in credit card interest. And a huge percentage of reward card users are actually losing money every single month without realizing it because of how these programs are designed. In the next 15 minutes, we're breaking down exactly how credit card rewards work behind the scenes, the 4 ways they quietly cost you more than they give back, and the specific conditions under which rewards actually do make sense. This isn't a video telling you to cut up your credit cards. It's a video showing you how the system is actually built, so you can use it without becoming the product. Let's get into it. Where rewards money actually comes from. To understand why rewards can be a trap, you first need to understand where that reward money comes from, because it's not coming out of the bank's generosity. Every time you swipe a credit card, the merchant, meaning the store or restaurant, pays a fee to the payment network, usually somewhere between 1 and 3% of the transaction. This is called an interchange fee. Part of that fee goes to the bank that issued your card. Your 1 to 3% cash back or points is essentially a small slice of that interchange fee, handed back to you as an incentive to keep using that specific card instead of a competitor's. Here's the part that matters. Merchants don't just absorb this cost quietly. Many build it into their prices. Studies on interchange fees have shown that these costs get passed on to all customers through slightly higher prices, whether you use a rewards card, a debit card, or cash, which means everyone is effectively paying a small rewards tax, but only the people using the right rewards card get any of it back. So rewards aren't free money from the bank. They're a redistribution of fees that already exist in the pricing system, and the bank only comes out ahead if enough cardholders don't fully capture the value being handed back to them. That's where the real traps begin. The interest trap. This is the single biggest way reward cards cost people money, and it's not close. Rewards credit cards typically carry interest rates between 20 and 29% APR. If you pay your balance in full every single month, that interest rate never touches you. But if you carry even a small balance, the math flips instantly against you. Let's walk through a real example. Say you spend $1,000 in a month and earn 2% cash back, $20. If you carry that $1,000 balance at a 24% interest rate, you'll pay roughly $20 in interest in a single month alone. Your entire rewards earning for that spending just got wiped out by 1 month of interest, and the balance is still sitting there accumulating more interest the next month. This is precisely why credit card companies can afford to hand out generous rewards. Industry data has consistently shown that a majority of cardholders carry a balance at least occasionally, and interest charges from those balances are one of the largest revenue sources for card issuers. The rewards programs are, in part, funded by the interest paid by the segment of users who don't pay in full. If there is one rule that determines whether rewards make you money or cost you money, it's this one. Rewards only work in your favor if you pay your statement balance in full, every single month, with no exceptions. The overspending trap. Here's a trap that has nothing to do with interest rates and everything to do with psychology. Multiple behavioral studies on payment methods have found that people tend to spend more when using credit cards compared to cash, partly because swiping a card doesn't create the same immediate sense of loss that handing over physical money does. Reward programs amplify this effect because now there's an additional incentive layered on top, the feeling that spending is somehow being rewarded. This shows up in small, easy-to-miss ways. Buying something slightly more expensive because it earns more points. Making an extra purchase to hit a spending threshold for a bonus category. Choosing to eat out instead of cooking at home because the card offers bonus dining rewards. None of these decisions feel irrational in the moment. Each one is individually small, but add them up over a year, and many people find they've spent several $100s more than they would have without the card, all to earn back 2 or 3% in rewards. You end up net negative even though every individual swipe felt like a win. The fix here isn't complicated, but it requires honesty with yourself. Track your spending for 1 full month with your rewards card and compare it to a typical month before you had it. If your spending increased by more than the rewards you're earning, the card is working against you, not for you. Annual fees and hidden costs. Premium rewards cards often come with annual fees ranging anywhere from $95 to several $100s a year, sometimes higher for the top-tier travel cards. These cards are marketed around their most impressive benefits: airport lounge access, travel credits, elevated point multipliers. And for people who travel frequently and use those specific benefits, the math genuinely works out. But here's the trap. Most cardholders don't use enough of the included benefits to justify the fee. A card with a $550 annual fee that includes a $200 travel credit only nets you real value if you actually use that travel credit, actually visit the lounges, and actually spend enough in bonus categories to make the higher earning rate worth it. Card issuers know this. They're counting on the fact that a portion of cardholders will keep the card open, paying the annual fee year after year, while using only a fraction of the perks. This is sometimes called a convenience tax. You're paying for benefits you rarely fully use, simply because canceling the card feels like a hassle or means losing some of the points already accumulated. Before keeping any card with an annual fee, do simple math once a year. Add up the actual dollar value of every benefit you used in the past 12 months. If it doesn't clearly exceed the fee, that card is quietly costing you money. Devalued and complicated redemptions. This trap is less obvious, but it's one of the most common ways cardholders lose value without realizing it. Points and miles are not fixed in value. Card issuers and airlines can and do change redemption charts, meaning the number of points required for a flight or hotel stay can increase over time, silently reducing what your points are actually worth. A flight that cost 25,000 points last year might cost 35,000 points this year for the exact same route. On top of that, many redemption options are deliberately structured to push you toward lower value choices. Redeeming points for cashback or gift cards often gives you significantly less value per point than redeeming for travel. Redeeming for merchandise through a rewards portal is frequently the worst value of all, sometimes worth less than half a cent per point. Then there's the points that simply never get used. Industry estimates suggest billions of dollars in credit card rewards points go unredeemed every year, either because they expire, because cardholders forget about them, or because the redemption process feels complicated enough that people give up. If you're earning rewards, treat them like an asset that needs active management, not a bonus you can ignore. Know your redemption options, understand roughly what a point or mile is worth in cents, and use them with some regularity instead of letting them accumulate indefinitely. When rewards actually make sense. After all of that, you might be wondering if rewards cards are worth it at all. For the right person, under the right conditions, they genuinely are. Here's the checklist. You pay your full statement balance every single month. No exceptions. Ever. Your spending habits don't change meaningfully because you have the card, meaning you're not buying more just to earn more. If there's an annual fee, you're actually using enough of the included benefits to justify it, based on real math, not assumptions. And you understand your redemption options well enough to get solid value out of your points instead of leaving them to sit or redeeming them for the lowest value options. If all four of those are true for you, a rewards card can genuinely put real money back in your pocket, essentially a small discount on spending you were already going to do anyway. The problem was never that rewards cards are inherently bad. The problem is that the marketing hides the conditions required to actually come out ahead. How to actually win with rewards. If you want to use rewards cards the right way, here's a simple framework. First, set up autopay for your full statement balance, not the minimum payment, so you're never at risk of carrying interest by accident. Second, pick one or two cards that match your actual spending patterns, groceries, gas, dining, whatever categories you spend the most in, rather than chasing every new sign-up bonus that comes along. Third, calendar a once-a-year review of any card with an annual fee, and honestly evaluate whether the benefits you used were worth more than the fee you paid. Fourth, redeem your points periodically instead of hoarding them indefinitely, since their value tends to shrink over time, not grow. And fifth, if you ever catch yourself buying something you wouldn't otherwise buy just to earn points, treat that as a warning sign, not a win. Credit card rewards aren't a scam, but they're not free money either. They're an incentive system designed by banks that only pays off for a specific type of user, someone who pays in full, spends deliberately, and actually uses what they're earning. If that's you, rewards can genuinely work in your favor. If it's not you yet, that's fine too. It just means the interest rate and your spending habits matter a lot more right now than which card gives you the most points. Take one action today. Pull up your last 3 credit card statements and check 2 things. Did you pay in full every month? And are you actually using the rewards you're earning? That answer will tell you everything you need to know about whether your card is working for you or against you. See you in the next video.